Hello, traders. It is Thursday, the 12th of September, 2019. It's 8:01 a.m. Chicago time. This is episode number 1594. We're approaching that 1600 mark. Not that it means anything. We just keep doing this and doing this and doing this. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. We have a market that has another another session in the extended hours of risk appetite. Um, and overall, we see it popping higher. What's interesting is gold is leading the pack. Gold is up 1.5%, up $22.80. Of course, on the ECB announcement, the ECB came in today. There were some expectations, but we got a surprise. And looking at the action in the Bund, I was alerted to the action in the Bund, and it's super. It was just pretty crazy in there. And overall, the ECB has decided to cut, and so it caused this big reaction in the markets. So that's where we stand currently. The president of the ECB is speaking, and the those of you who are trading any pair with the euro, European products, and so on, should pay attention to what's going on there. So it also announced that it's going to relaunch its QE program at the valuation at about 20 billion euros per month. It revises forward guidance with no specific end date. And these are big things. I mean, they cut their deposit rate by 10 basis points, which was expected. The restart of QE was not, causing, of course, a devaluation of their currency, and gold popped higher. The euro stocks are stronger. The equity market loves that sort of thing. We actually saw a drop, a quick flush on that news before it started to turn around and climb higher in the U.S. indices. Um, so that's where we stand. The laggard today is crude. Crude really had a trend day down yesterday. It really took a bit of a beating, and it continues today. It's down 2.44% from settlement on the October contract. The first thing I want to do before I go into, well, let's take a look at what's expected. Remember, today was a kind of a busy day release-wise. Those of you who are in the treasuries, don't forget there's a 30-year bond auction at 12 Central, 1 Eastern, and then we get the monthly budget, U.S. monthly budget, which is a low-tier figure. Expecting, get this, monthly budget. We expect a negative 195 billion release on that. The prior is negative 120 billion. So much for balancing the books. So this is where we are. In terms of one quick announcement that's really important before we look at charts is, as I'd warned all week, that rollover's coming today. The front month for the futures, the U.S. index futures, is December now. It's thin, and it's not my favorite time of the year. In fact, there's going to be a new policy that I'm taking this Thursday to Wednesday off or something every quarter. It's not fun trading this period, but the rollover takes place. I'm trading December, and for those of you who don't understand how this works, the futures roll a week before expiration. Expiration Fridays, next Friday is quad witching Friday, and we move to the next contract the prior Thursday, which is today officially. The December contract is going to be quite thin relative to September. Many people stay on September, but my data feed, IQ feed, rolls, and I delete all of the historical data and reload, and then I make sure that all my levels and stuff like that are adjusted by the premium difference of the two contracts. The premium difference is in front of you on the screen. It's plus 1.75, meaning the December contracts trading at a higher price than September, which is what we would expect. We call that contango. And those are the values. So for NQ, it's plus 21. So you have to adjust your levels that much if you're moving to December, and adjust your data before today by that much. You have to increase everything by 21 points for it to match. Otherwise, you end up with a big gap that didn't really exist. So back to business. Here's what I expected yesterday, and I was quite confident in my read. And this is what the market does, right? You tend to feel like you tend to see things, and it seems like a lot of clarity. So yesterday um, I was quite expecting the market to pull back to 29.79, and unfortunately for today, I have to quote the September contract prices. Even though we're trading December now, just add 1.75 points. So in today's contract, it'll be 29. The MC point of control is at 29.80.75. I expected the market to pull back to there, drop as far as 75, potentially to 71, and I expected a range between 71 and 87, and I expected it to hold sideways and prepare for ECB for the next launch, either down or up. And that was the expectation yesterday. Incidentally, I made an announcement yesterday that I'm going to stop doing the scenarios, showing the scenarios, because they just raise too many questions. I get too many emails, I get too many comments. Other people, quote unquote, educators, make comments that you shouldn't predict the market. But of course, they don't know what this is all about, or don't understand, or don't want to. And so I thought maybe it's easier to just talk about the key areas and let everybody kind of figure out what their expectations are, what their plan is. I got a ton of emails, a ton of DMs on Twitter, and there's a thread on Twitter saying whoever's complaining is an idiot and all that. And I don't think that's the case. Um, it was worth it for me to try it and just point out the key areas I expect the market to turn is marked in front of you, 75. If not, then 71.75. So holding a short from the open, I'd want to hold for 71.75, and the targets above is those arrows at 87.88. However, it just isn't. It's not worth the hassle changing something that people are used to, and it seems like it would be better for me to just bring those back. And just do what I've been doing, which is to explain that these aren't predictions. I'm not trying to make the market do what I want it to do. I'm using auction. I'm using very well known and something I've studied since 2005. I'm using auction principles to create a plan of attack for the day, but the day can play out however the heck it wants. It doesn't mean that I have to stick to the scenario. It tells me what's expected under normal circumstances, in my opinion. Those last three words, the last three words really make a difference. In my opinion, under normal circumstances, this is what we would expect the auction to do. Now, that brings us to yesterday. And yesterday, in my opinion, it was likely to revert back to 29.79, the MC point of control, bounce around, get down to 75, and potentially test 71, but 75 is an important area. And then the range I expected between 71 and 87. That's what I expected. The thing is, when I don't get what I expected, I like that too. Whereas other people might think, well, you didn't get what you expected, ha ha ha, loser, whatever. But actually, when the market doesn't do what's expected, it actually creates a unique opportunity. I've talked about this quite a bit. To those who've been around and listened to my webinars, I talk about the Monty Hall problem, right? If door number one doesn't have the prize behind it, then it must be behind door number two or three. And if we know what's behind door number one, we can bet on the alternative and change our decision, our plan to accommodate the alternative, and we can be more aggressive about it statistically. So if the probability for one out of three doors, the game is there's a big prize. It's usually a Corvette or something, and then the other two doors have like a goat behind them or something. One door has a goat behind it, one door's empty. And so you have a 33% probability of randomly picking the Corvette. And not that that's my favorite car, but and then what happens is Monty Hall says, and I'm going to make this easier for you. So I'm going to make this so that I'm going to open one door. And the clue is the door that is opened by Monty Hall is always the one that's empty. It's not the one that has the goat, it's the one that's empty. Most people think, well, now I have two doors and it's a 50-50 chance. It's not a 50-50 chance statistically. It's still the just because the door was open, we just eliminated a 33% probability, but we have a 66% probability remaining in the other two doors. And the better idea is to change your answer. So if you thought it was door number two, number one was opened and it was empty. If you thought it was number two, you have a better probability of switching your answer to door number three to take advantage of the fact that that gives you the 66% chance. Wikipedia it. I've used this principle for a long time that if the market doesn't do what I expect, it's likely to surprise a lot of people who are looking at things in a similar way. I'm looking at the overall structure in the auction, and if it doesn't perform that way, it actually gives me a strong opportunity to do something else. So that's what we've got. We've got a market that pulled back. It actually pulled back because these prices are in December prices. The low here, it says 29.7650, but actually the low was that exact price that I put a circle around, which is 77 and a quarter. Again, here it is. I put a circle around this price, which is this price, this point right here. Okay, and the market pulled right back to that. It pulled right back to this point right here. That's the same equivalent point, except it's in a December contract. And so it held, and we saw buyers come in. It made a small double top here, a weak high. We expected the break and then look for a pullback to that area, to mid, to whatever. And what we had is confluence right here. This is the cleanest, clearest opportunity I saw for the day. It took a while for it to resolve. This is the big area I expected the market to test and to struggle with, and it was 87 in the recording. Yesterday's recording was 87.50. This is the area that I expected the market to struggle with, and if it could not break through, I expected it to roll over and start making its way down to 71.75 in the old contract. And that didn't happen. It ended up breaking higher, and again we got a pullback test, kind of like how it broke higher and pulled back here. It pulled back here to the prior zipper, and we continue on and so on and so forth. It was a very sluggish run up, but we ended up with a very quite a poor high point of control near the upper end of the range. Of course, this is on the December contract, so it's not very clean. But overall, the market had really strong buy delta yesterday with price climbing. So we finished very strong. The expectation is that it did not actually it did not achieve its purpose. Remember, the market's purpose is to climb higher, to advertise higher prices, to entice sellers to step in. This is why we do it. It's called price discovery. We're discovering higher and higher and higher prices. It's an auction, kind of like a Christie's or Sotheby's auction, and we look for who's going to step in. And so that's what we're looking at. Oh, I've got the date wrong. I appreciate you pointing that out. I'll change that in a bit. So that's what we've got. And then because the auction was interrupted on the close, what do we expect on a kind of a trend day up? We expect it to continue to float up into the overnight session. And it did. Okay, so let's go to the overnight session and take a look at that. Here we go. We open up and zip. We have this big push on news, and then since then we've just simply drifted down. We had more news here with the ECB, as I said. We dropped pretty good, and then we came back up to the SOC, made a higher point, and then we held right in the center. What we see in the overnight session, again, this is kind of thin. What we see in the overnight session is that the point of control mid VWAP are on top of each other. We've got, I can't discuss the volume here because the volume is going to be way off on the December contract versus September. I actually wouldn't mind IQ feed holding for a day on this roll, but um, it's where we're set up is that we're accepting equilibrium and we're accepting prices above the prior day's high and holding steady here in the middle. So we're going to end up opening in um, a small gap above the 3,000 figure. There was a little spike once we got through 3,000 yesterday, pushing a lot of players out. And so it's kind of interesting that we're finally back here and we're very, very close to new all-time highs. The market's anticipating with the ECB dropping rates and the expectation of a drop. I mean, they expected a 50 basis point drop. The market's anticipating that the Fed's going to have to be accommodative, and POTUS is out there on his Twitter account screaming for it. So we'll see what happens in the next meeting. Or what would be interesting is we get a surprise adjustment, right? Mid-cycle, we get a surprise adjustment by the FOMC that would cause the market to go bananas for us to see probably 3,200 right quick. So we'll see what happens. So that brings us, it's a lot of talking, right? So that brings us to ahora. Brings us to today and where we are today. So let's take a look at that. The expectation for this morning with this gap open is that we are going to have, we're likely to have a response. We're opening in a gap. We have not been in this region for some time. Expect an OTD or a driver in here. Expect an open test drive type opening, open rejection reverse, or an open drive. The fact that the market's in equilibrium overnight is likely to give us an open auction, but again, I would not fight this on the open. I'm going to do the usual thing and just chill and let the market kind of figure its thing out. But I'm expecting a reversion back towards yesterday's action. I'm expecting it to balance out, test the 3004, potentially a 3001 area before it gets the bounce back up, and then we start to push higher. This is the primary scenario, a responsive selling and an initiative away from where we are. Secondary scenario is an open test up responsive drive, brings us back to 3004, 3001, and then we come back and retest this 2990-ish area in the new contract. This is the old 8750 or so before we bounce back up and then come right back out and hold sideways. Both responsive scenarios. The third scenario that's likely is an open test down drive up that brings in some more of a short squeeze, and then we start to push towards the overnight high, and we start to drift towards in that case, I'm looking for 3023 to be the area that's likely to be tested. So it might have a smaller pullback, but what we're looking for is the impulse, right? We're always paying attention to that impulse. The impulse helps us see which side is serious with their intentions, and it gives us an opportunity to get in on the pullback and ride the continuation. Okay, it's 20 minutes after the hour. I've been talking for 20 minutes. Hopefully that makes sense to you. Again, I'm quoting the December contract today, despite the volume being light. Don't forget that because of rollover and until the pace of the roll says that almost all of it has rolled, you have to be very cautious with the volume delta. Um, with the volume delta and any delta type information, we're going to have to be cautious all the way through to next Friday. The pace of the roll the last couple of times has been faster than expected. It was slow at first, faster than expected. And actually, last time, the June to September roll actually finished by Wednesday. Pretty much it was done by Wednesday, which made it nice. But we'll see how it goes today. And then I'll talk to you tomorrow morning. Okay, good luck, everyone.